Okay, let's dive right into this explainer and uncover the real math behind today's soaring auto loans. Look, if you've been car shopping recently, you've probably experienced some major sticker shock, right? The landscape of buying a vehicle in 2026 is just vastly different than it was even a few years ago. We're seeing record high prices, incredibly long loan terms, and interest rates that can legitimately derail your financial future. So, my goal today is to help you navigate your next car purchase smartly, using the very latest data to help protect your wallet.
Here's our roadmap for today. First, we'll look at the auto debt boom. Second, the true cost of cars. Third, credit scores and rates. Fourth, budgeting car payments. And finally, we'll wrap up with some smart shopping strategies. Let's get right to it.
Section 1, the auto debt boom. Let's look at the big macroeconomic picture here. According to the latest numbers from the Federal Reserve Bank of New York, total outstanding U.S. auto loan debt just hit a staggering $1.69 trillion in the first quarter of 2026. $1.69 trillion with a T. This isn't just a tiny seasonal uptake. Overall vehicle debt has grown massively over the last decade. We're talking about Americans borrowing hundreds of billions of dollars every single quarter, literally just to keep vehicles in their driveways.
Now, when you zoom out and look at all American consumer debt, mortgages naturally take the lion's share at just over 70%. Makes sense. But guess what's right behind it? Auto debt. Making up 8.9% of total consumer debt, it actually slightly edges out student loans. Yep, you heard that right. Cars are now the second largest debt category for the American public.
So, what exactly does that look like for you and me on an individual level? Well, Experian data shows the average monthly payment for a new car has reached a record, $767. And hey, if you're thinking, I'll just buy used and escape all that, think again. The average used car payment has also climbed, hitting $537 a month. Even leasing, which, usually gives you a lower monthly footprint, is sitting at an average of $613. But brace yourself, because here's what's really shocking. Nearly 1 in 5 consumers buying a new car, almost 19% of people, are taking on a monthly payment of over $1,000. $1,000 a month. For a lot of households, a car payment is starting to look dangerously close to a rent or mortgage payment. Which brings us to Section 2, the true cost of cars. Let's dig behind these numbers. How are people affording these higher prices without their monthly payments totally exploding? Well, borrowers are stretching out their loan terms. The average loan term right now is 68.9 months for a new car and nearly 68 months for a used car. We are nearing 6 straight years of payments on average. And for some borrowers, particularly those with lower credit scores, those terms are stretching out past 75 months, over 6 years of carrying car debt. LendingTree's chief consumer finance analyst, Matt Scholes, hits the nail on the head here. He warns us about a major trap. Extending your loan term keeps you paying interest on an asset that rapidly loses its value. According to Kelley Blue Book, cars can lose up to 60% of their value over time. So, if you stretch a loan out for 6 or 7 years, you run a huge risk of becoming underwater. That simply means you owe the bank way more than the car is actually worth.
Plus, you've got to remember, the true cost of a car goes way beyond just the sticker price or that monthly loan payment. You absolutely have to factor in the immediate fees, taxes, titles, non-negotiable dealer fees, and the ongoing operational expenses. Once you add in your insurance, your fuel, and routine maintenance, that $767 average payment easily drains over $1,000 from your monthly cash flow.
Moving on to Section 3, credit scores and auto rates. Let's talk about the real impact on your wallet. Experian's data reveals a pretty dramatic penalty if you have a lower credit score. Check this out. A super prime borrower, someone with a score over 781, is getting an average rate of 4.66% on a new car. But a deep subprime borrower, they are paying 16.01%. And for used cars, it's even more extreme, pushing nearly 22% for subprime borrowers. That massive double-digit difference translates to literally thousands and thousands of dollars in extra interest paid over a 68-month loan term. And unfortunately, we are seeing the real-world consequences of these heavy financial burdens right now. As of the first quarter of 2026, the 90-day auto loan delinquency rate has climbed to 5.2%. We haven't seen peaks like this in over a decade. Borrowers are really feeling the squeeze, and when budgets break, car payments are the ones being missed.
Okay, let's switch gears and talk strategy. Section 4, budgeting your car payment. Financial tools like the Investing Lab Budget Planner utilize widely cited guidelines like the 50-30-20 rule. You've probably heard of this. It suggests allocating 50% of your take-home pay to your needs, 30% to wants, and 20% to savings and debt repayment. Your car payment, along with auto insurance and gas, falls squarely into that 50% needs category. If your $767 car payment is pushing your total needs past 50% of your income, well, you're simply buying too much car. When you sit down to build your budget, it is absolutely critical to remember that a car loan is a fixed expense. It is not going to magically change from month to month. You can't just call up the bank and negotiate your car payment down because you had a bad month at work. If things get tight, you'll be forced to slash your variable expenses like your grocery bill or dining out just to keep your car from being repossessed.
Which leads us perfectly into our final section, number 5, smart shopping strategies. Let's protect that wallet.
The Consumer Financial Protection Bureau actually recommends these 4 steps to make sure you are negotiating from a position of absolute power. Step 1. Check your credit report for errors before you even start shopping. Step 2. Calculate what you can actually afford to spend. Step 3. Shop around. Compare multiple lenders. Do not just blindly take the dealer's financing. And Step 4. Get pre-approved for a loan by a bank or credit union. Walking into a dealership with a pre-approval letter in your hand gives you incredible leverage. The dealer immediately knows you aren't desperate for their financing options. The absolute crucial point here is to actively reduce the principal amount you are borrowing. How do you do that? Use down payments. Data shows drivers are putting down an average of over $6,800 for new cars recently. Combine a solid down payment with a well-researched trade-in value, actively choose a slightly less expensive vehicle, and flat out refuse those optional dealer add-ons. Look, every single dollar you don't borrow is a dollar you aren't paying 7% or 10% interest on for the next 6 years. And as a final reality check, never, ever look just at the quoted loan payment. You've got to map out the total monthly vehicle cost. Add that auto loan payment, your car insurance premiums, your estimated fuel costs, and your routine maintenance and repairs. Only then do you truly understand the vehicle's monthly drain on your budget. Ultimately, the auto industry wants you to focus on just one thing: a shiny, affordable-looking monthly payment, even if it takes you 84 months to pay it off. But by doing the math up front, understanding your credit, and securing that pre-approval, you completely flip the dynamic. So ask yourself, are you letting a monthly payment dictate your budget? Or are you letting your budget dictate your car? Take the wheel on your financial future, do your homework, and you can drive off without the massive burden of excessive debt. Thanks for joining me on this explainer, and happy smart shopping.